Hey traders, Todd Gordon here with TradingAnalysis.com. This is CNBC's Trading Nation. Traders, we're going to take a look at a warning sign in the stock market that is given to us by the three other major asset classes. So we're going to take a look at the S&P within the context of the fixed income market, the commodity market, and the currency market. There's a warning sign that we need to be paying very close attention to. So let's dive in. I'll show you what I'm talking about. So to start, let's take a look at the SPY, which is the tracking stock of the S&P 500, on top of UUP, which is the dollar ETF. First thing you'll notice is that UUP topped out here in late 2016 and early 2017 and begin to push lower. This is at the same time, the stock market did go sideways for a period of time, but has continued higher. And if you look back, you can see that the two have enjoyed somewhat of a positive correlation. So weakness in the dollar is starting to suggest perhaps the economy is not quite as strong as we thought. Either possibility a result of Trump's policies, or perhaps an earnings season that's not been met with numbers that we were expecting. There's a couple different possibilities. The other market I want to take a look at is S&P 500 again, but let's take a look at it over the gold and the bond markets. And this, I think, is very interesting. Again, the S&P 500 has rallied into the end of 2016 and now into 2017, but notice what's happened in gold and bonds. Gold put in a firm bottom here and has rallied. Bonds have put in a firm bottom here and have rallied. So why are gold and bonds rallying alongside the S&P 500? Something doesn't add up there. It's either a Fed that's going to be much more accommodative for much longer than we thought, and that's why we're seeing the dollar sell off with gold and bonds rallying, or if in fact the Fed is prepared to go ahead and continue to raise rates. Perhaps we're starting to see a run into the safety of gold and bonds out of the dollar because the stock market might not like the future interest rate increases. So there's a major warning sign going on here. We got to see how this ultimately resumes. My belief here, traders, the way I'm going to be looking to do this is I think there is major resistance coming into the 2300 to the 2350 level in the S&P, which will eventually give us a bit of a sell-off. So the way I'm looking to play this over in the bond market, just in the short term, just to get this thing going, is I want to play the long side of TLT, just a little break from this recent consolidation from about $120 up to the recent highs of about $123. So we can go ahead and do that in the options market with a defined risk bet. So if we go over to the trade tab, I'm looking out to the March 3 options. We're going to go ahead and buy the 120 call, sell the 123. Altogether, you're going to do that for about 95 cents. So you have basically a 2-part reward to 1-part risk in the bond market. And again, if gold and bonds and that dollar that's selling off are any indication, there could be a run into the safety markets as we just described, and perhaps out of the stock market. So that's the trade. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that trade and that market observation. We'll see how it plays out. Be sure to follow us at Trading Nation on Twitter for updates to these market observations as well as all the other markets our traders are following, and we'll see you on the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.